You all know that an index fund tracks an index like the ASX 200. It seeks to exactly replicate that index so that your return is the same as the index. You're not trying to beat the market. You're not going to beat the market. But you're not going to lose or go behind the market either. You will get the market returns. That's what indexing is all about. Why has indexing, though, on average, been more successful than active management over the years? One of those factors is cost. We know that indexing is low cost and the compounding effects of cost over time really matter. I'll get into that in another slide later on. But another thing I wanted to talk about why indexing works, and which is very important, is the limited opportunity set of investments that can beat the index, or skewness as it's known statistically. So let me pull up a chart here and let me just talk you through this. This is a chart of the ASX 300, so the top 300 stocks on the ASX in the year 2024 and what they did versus the index. Now, what you can see there is that median 3.2%. That's the middle stock of those 300 stocks. So the 150th best performing stock in the index gave you a 3.2% return in 2024. But the index itself gave you an 11.4% return. Of the 300 stocks in that index, 39% or only 39% of the stocks actually outperform the index, meaning 60 or 61% of the stocks underperform the index. So just on a purely statistical basis, you've got basically a 4 in 10 chance of picking a stock that outperforms the index if you're just, randomly choosing one stock or another. That's over 1 year. Now, let me pull back a little bit and show you what happened over 20 years. Over 20 years, from 04 to 24, the ASX 300 index was up 361%. However, the middle stock in that index, the 150th best performing stock out of the ASX 300, was down 10.7%. Only 8.2% of the stocks in that index actually outperformed the index's 361% return. So now, instead of doing 1 year, you're having a 40% chance of picking a stock that outperforms. You're down to under 10%, 8% chance of picking any one stock that outperforms the index over those 20 years. And it's that limited opportunity set. Basically, to beat the index, you've got to choose stocks that are within that 8% of the ASX 300 in order to beat the index over time. And statistically, that's just not that likely. Here's the numbers for the US market. So this is the S&P 500 over 20 years. So same time frame as the slide just before. The index was up 616% in 20 years. The median stock was up only 68%. So the index is almost 10x what the median or the 250th stock in the S&P 500 did. Only 13.6% outperformed. And if you have a look at that chart, the far right-hand tail there, that's where all your outperformance came from. And guess what? We all know those stocks. That's NVIDIA, that's Tesla, that's Apple, Google, Facebook, and so on and so forth. So, yeah, you might have picked those stocks and well done, but the statistical likelihood of doing that is very, very low. So as we always say, one of the catchphrases we use is don't look for the needle in the haystack, just buy the haystack, because you get the needles. You get all the needles that are in there. Just buy the haystack. And that theme will recur as we go through index investing and asset class allocations and so on. But that's the skewness of returns. And just remember that there's not a large opportunity set of investments that actually beat the index, which is why it's so hard for active managers to beat the index. So you may as well just buy the haystack, buy the index, and you get those index returns. So why Vanguard? Well, I just went through, we're a mutual fund. That makes us different to all of our competitors. And that gives us a slightly different philosophy on investing, I think. There's some other reasons why we think, we're the best in the business. The incentives at the top there, we're a mutual fund, have gone through that. Portfolio management and indexing is a scale business, the bottom one. Look, because we've got $16 trillion under management, we get the best execution, the best brokerage relationships, all of that around the world. So our traders are the most efficient in the world because everyone wants to deal with us, obviously, because we've got so much money under management. Other fees, so things like buy-sell spreads, we've got the narrowest spreads in the market. So that means when you're buying and selling, you get the best prices, the narrowest spreads, which means you're not giving up money to the market makers or during the trade. One other thing I wanted to talk about is securities lending, and this feeds back into the whole mutual fund thing. Well, first of all, I should explain what securities lending is. Securities lending, all fund managers do it. What they do is they lend some of the shares in the portfolio, like Commonwealth Bank, for example. We will lend that to another fund manager, like a hedge fund, that wants to short that stock because they think the stock is going to go down. So we lend it to them, they sell it, hoping to buy it back at a lower price and then return that stock to us. So we haven't lost any money. It's still part of our portfolio, but we get a fee for doing that. Well, being a mutual fund, Vanguard returns 100% of those fees to the fund that lent out those shares. That is not true for some of our competitors. So let me show the impact of how that looks in a portfolio. Here are the 4 big Australian ETFs tracking the Australian index in Australia. So the Vanguard ETF VAS, then we've got the iShares, the Spider one, and also the BetaShares 200 ETF as well. When you think about it, the perfect index fund should give you the return of the index minus the fee that the fund charges. So Vanguard charges 7 basis points or 0.07% annual for management of VAS, the Australian Index Shares Fund. So you should see the ASX 300 minus 7 basis points as your return. What you actually see is minus 2 basis points. So we actually added back 5 basis points of performance through things like stock lending, where we just put 100% of the revenue straight back into the fund. If you look at our competitors who headline all have a slightly lower fee than the Vanguard fund here, have a look at the actual outcomes. Even though they charge slightly less than us, they're actually down 16 bips, 8 bips, 7 bips compared to the index over 1 year. And if you look out 3, 5, 10 years, then we're clearly outperforming them. And again, this goes back to the whole mutual fund thing. We give all of our revenues back to the funds, our competitors, because they're profit-seeking businesses essentially do not. So just sort of keep that in mind. It's not all about headline fees. It's also about the outcomes of the fund as well.
Sorry, Tamas.
So moving on, yes.
Just to jump in, we have a question from Alex that's related to your slides on the skewness. He wants to know if it also works the other way, i.e. when those big few companies have an off day, does that make your... are you heading backwards then as well, I think is what he's trying to say?
They do. I suppose they dominate the index. So if the Mag 7, Tesla, Google, Facebook, etc., if they're down, they make up 30% of the S&P 500 index by weight. So yeah, the index is going down. And it's going to drag the index down disproportionately, compared to being only 7 stocks in the index versus the other 493. So it kind of works the other way. I guess what I'd point out to you is just looking at this graph here is that you have relatively few stocks that tend to outperform the index. Lots of ones around the middle, but there's a big left-hand tail of underperformers as well. So there's a lot of, like dogs in the index that you want to try, if you're an active manager, to try and avoid. But how do you know which ones those are? It's very, very difficult to know. So I think that answers your question, is that yes, given that those superstar stocks dominate the index, if they fall, yes, the whole index falls as well. But by owning the index, you own those stocks whether they go up or down. So hopefully I think that might answer the question.
Thanks
let
very
me know
much.
if it does or doesn't.
Just let us know if in the chat there, Alex, if that answers your question. Thanks, Tamas.
No worries. No worries. Look, moving into Vanguard's investment philosophy, you've probably all seen charts like this before. It's all about compound growth. The idea being just leave your money in there, and over time, that money is going to grow. If you reinvest all the distributions as well, over time, if you're starting at $10,000 back in the 1990s, by today, if you're in US shares, you'd have 237,000, Australian shares 135,000, so on and so forth. It's all about compound growth over time. I'm sure your advisors have explained that to you. But let's talk about compound growth, because we know that compound growth is interspersed with bear markets, with markets that sometimes do go down. In the beginning of the chat here, we talked about the Trump tariffs at the beginning of the year, where markets kind of went down for a while, but then came straight back. But what this chart shows you is that over time, bull markets are far more persistent and far greater in magnitude than bear markets. So if you look at this one here, I'm looking at between 81 up to the 87 share crash. The market was up over 500%. Then it was down 43%, in October 87. Then we had a couple of years there up and down, but then starting in around about the early 1990s, we had this long bear market, almost 17 years in length, up 900%. Okay, bear market comes along, you're down 48%, but then that's, the GFC. But then post-GFC market, 11-year bull market, up 242%. COVID comes along, we're down 27%, but since then, we're back up 84%, almost 85%. So the lesson from this slide, bull markets are far greater in persistence and magnitude than bear markets are. That's why you stay in the market. That's why compound, investing works over the long term. Further to that, let me just show you this chart. So this is a chart of global stock market volatility. So what this what all the little bars are showing you is that day by day, month by month here, how much did shares go up or go down in any one particular day? What should jump out at you about this chart is that volatility is clustered. So you can see in 87 there, yeah, sure, the market was down 10% one day, but it also was up 10% one day as well. And then look at the GFC. You've got all these brown lines going down sort of close to 7-10%, but also interspersed with days where the market was up 5-10% as well. The blurbs here, I think, put it well. 10 of the 20 best trading days occurred in years with negative total returns, and 11 of the 20 worst trading days occurred in years with positive total returns. The point being here, don't panic. If the market's down 10% one day, statistically, that probably means it's going to be up 5, 7, 10% as well in the coming days. Volatility is clustered. So when you see these big market movements, that's not a sign to panic and get out. That's a sign to hang in there because you know that the recovery is going to come. And traditionally, what we see with this type of clustering of volatility is that, the down days are often often followed by strong up days as well. It's just volatility jumps up both ways. This is an asset price or an asset class quilt, as we call it. It's a very busy page, but let me explain it to you. The colors denote the asset class. So you can see on the left there, international equities, DM, what that means is developed market and hedged into Australian dollars, then Australian property in the dark green, Australian equities in the maroon or whatever that is, international equities, emerging markets in the orange, and so on. We then rank those asset classes by their returns year by year by year. So you can see 2013, it was, in fact, international equities number one, followed by Australian property for the next 3 years, and so on and so forth. What should jump out at you from this is the randomness of the returns. There is no way anyone could have predicted which asset class was going to be the top performer in any one of those years, year after year after year. It's impossible. You cannot predict that. And not just the top performing asset classes, but numbers 2, 3, and 4 as well. It's impossible. Markets are random. You don't know what's going to happen with each asset class in the future. And that's why we say, hold a diversified portfolio, hold all of the asset classes. It's like the ASX 300 chart that I just showed you. Don't look for the needle in the haystack, just buy the haystack. Same thing with asset classes themselves. Don't go for the top performing asset class every year because there's no way you can predict what that's going to be. Just hold all of the asset classes. And over time, they will grow. They won't always be the top one. Sometimes they will be, but you will always hold the top performing asset class if you are exposed to all of them. Look, a note on compounding returns. I don't want to go over this too much, but this is just a very simple graph showing that the more you save, the quicker you get to your goals. So if you've got, just looking at the 7% returns down the bottom there, if you don't increase your savings at all, you're going to hit your target of 500,000, starting with, I think it's 10,000 here. Assuming the returns here, you'll hit it after 37 years. If you increase your savings year after year by just 5% every year, that shortens that timeline right down. So compounding, it is one of the wonders of investing. And this just shows that the more you save, the more you get that compounding effect and the quicker you reach your investment goals. I do have to talk about costs though, because what this shows you is not just the miracle of compounding returns, but you've got to subtract out the tyranny of compound costs as well. Cost matters, and it especially matters when you compound it up over time. So looking at this graph, if you invest $100,000 and you get a 6% return off that, which you reinvest every year as you go forward. If you have zero fees for that, then you wind up in 30 years' time with $574,000. Now, zero fees is not realistic. Someone's got to manage that money for you. So let's say you pay 25 basis points or 0.25% in fees for those funds under management. Okay, you get $532,000 after 30 years. But if you increase those costs to 91 basis points, all of a sudden, well, not all of a sudden, over time, over that 30 years, you're down to $437,000. So that's just an illustration of the effect of compounding costs. Those numbers, by the way, so 25 bips is the weighted average portfolio cost that Vanguard has across all of its funds, and 91 basis points is the weighted average cost of actively managed funds in Australia. So this is just effectively showing Vanguard versus active, assuming the same returns for each over that time, but it just shows you the impact of compounding costs over time. Costs matter. Go for the low-cost stuff. Make that the core of your portfolio. None of this is specific advice, of course, it's all general, but make that the low-cost stuff the core of your portfolio, and that means that you will not experience that tyranny of compounding costs over time, but you will mostly benefit from that miracle of compounding returns. So look, that's Vanguard. That's our investment philosophy. That's why we do what we do, and we really push for diversifications of portfolios. Staying in the market, not trading around it and trying to beat the market, and low-cost index investing over time. That's essentially the way Vanguard thinks, and the way our funds are all structured. But look, let's talk about the markets quickly. What happened in 2025? I've only got the data up to October of 25 here. Not a lot has changed since then. Gold is the standout performer this year. We all know that story, up 44%. Australian shares were up 12% to October. And small caps had a great year, up 25%. And then global equities up 13%. And the hedge version of that, just 18% or so. So look, they're the asset class returns for 2025 year to date. It's been a pretty good year across the board. But I think what we should do is just a couple of specifics I wanted to get into. US equities are the big story of the last couple of years, really. Again, remember I showed the S&P 500 graph. It's all been dragged by those Mag 7 stocks and what's going on with tech in the US. And it's been an incredible market there. But if you look sort of more deeply across the S&P 500 and US equities in general, one thing that is driving the valuation of US equities at the moment is profit margins. Profit margins are about 28% above their historical average. So margins are up around about 12.8% versus the historic average of 10%. That drives valuations up because people see profit margins going up, so they will pay more for those increased profit margins. That drives up valuations. So that's part of what's been going on. That's actually a good story. That means it's a sustainable increase in valuations because of those profit margins. But valuation ratios are also stretched. So not only we've seen profit margins up, but the return on equity here, what we're seeing is that basically it's gone from 19 to 27, 28. What that means is for every dollar of cash flows, you have to pay, you traditionally, historically have paid about $19. Currently, you're now paying $27, $28 for every dollar of cash flows that you get. So, i.e., it used to take 19 years to pay back the dollar that you put in. It now takes 27 years to pay back the dollar. That means stocks are more expensive. However, another qualification here, half of that overvaluation can be explained by the tech sector and what we call rate lock as well. This is slightly complicated, but because we've been through such an extended period of very, very low interest rates, it means that companies can borrow very, very cheaply, and they've locked in a lot of long-term loans at very, very low interest rates. Now, interest rates have gone up a little bit, but they've still got those loans on their books and they're not paying much interest for them. overall, essentially what that does, and this gets a little technical, but it just means that when you discount the future cash flows of those companies at a lower rate, you get a much higher valuation in those future years. So the discounted cash flow analysis, it basically means that we've lowered our cost of capital for US companies. And that, is a good thing, because that means the excess money can go back to investors and so on. But that rate lock, is an artifact of artificially low interest rates that we've had for some time. What that means, however, is that all else being equal, and nothing ever is all equal throughout this time, but let's just say all else being equal, we would therefore expect US shares to underperform international shares over the next few years. And that's simply because international shares don't have that same valuation. What's the word I'm looking for here? The valuation margin, I suppose, that US stocks had. They've got a lower PE ratio, essentially. The valuation ratios, that's the word I was looking for. So we would expect those things to effectively even over time, which means US stocks will probably underperform international stocks as international stocks, catch up. That's all else being equal, but who knows? I mean, maybe we'll see another Mag 7 come along in AI or something like that. We just don't know. But all else being equal, you would expect that the US would underperform international stocks at the time, just because the valuations look a little bit stretched at the moment. Here's just a quick graph of showing where all of the various asset classes, according to various valuation metrics. Not a lot of asset classes are undervalued at the moment by the metrics. US value and US small caps are. Most things are pretty fairly valued at the moment, but there are some stretch valuations like US equities. Some of the emerging markets look a bit stretched there as well. There are some asset classes that have got stretch valuations at the moment, but for the most part, a lot of them are pretty fairly valued as well. So we're not talking about a total crazy kind of bull market like we saw back in the dot-com late 1990s or anything like that. We're just seeing some slightly stretched valuations, some based on fundamentals, but also some based on expanding ratios as well. This graph, I just wanted to talk to you. This is July 2024 up to 24, so just over a year ago. But I think it's a really good illustration just of why you diversify your portfolio between stocks and bonds. So this is just a chart on the left there, just showing what happened to global equities in sort of mid 2024. Global equities went down. Okay, so if your portfolio is full of stocks, US, European, Australian stocks, it went down. But if you had bonds in your portfolio as well, that counterbalanced that to some extent. So bonds went up during that time. Stocks went down, bonds went up. If you held both in your portfolio stays in the middle. This is a story of diversification. It's what we were talking about before with the asset class quilt. Just keep your portfolio diversified. And then when something like this happens with stocks, shouldn't matter too much, because you've got the other half of your portfolio balancing that out with the bonds and other asset classes that you have in your portfolio. Just a note on bonds versus term deposits. This has been quite a frequent topic over the last couple of years, because a lot of people have been in term deposits because they were paying more than bonds were for some time there. And the bonds went through that very bad period in 21 and 22 as well. But I just wanted to point out the historical averages here. On average, bonds pay more than term deposits. They're longer term debt. You get paid more for longer term debt, and so you'll earn more for it. Term deposits are short-term debt. You don't earn as much for short-term debt, so on average, your returns are lower. There have been a couple of years where that wasn't true, and a lot of people went into term deposits, but I just wanted to point out that over time, bonds pay more than term deposits, and we're heading back into that sort of normal state of affairs now after a couple of years where bonds underperformed. But speaking about predictions of the future, I just had to throw this one in because I love this chart. Let me explain it to you. This is the US federal funds rate, so interest rates as set by the US Federal Reserve. That's the thick black line. That's where rates have been over the last 20 years, just over. Those little blue lines coming off that are the implied interest rates predicted by the futures curve in the futures markets in the US. So if you look at 2024 down the bottom of that chart there, you can see the rates were starting to go up, but the futures market would say, okay, they're going up a bit, but then they'll level off. Then they kept going up. Oh, okay, they're going up a bit. Then they'll level off. Then they'll level off. Then they'll level off. Then rates topped, and everyone was saying, okay, we're at the top. They might come down a bit, down a bit. Then rates collapsed during the GFC, and the futures market did not predict that. Then we had this long period from 08 through to about 16 where interest rates just stayed on the floor, and the markets kept predicting, okay, next year they're going up, next year they're going up, next year they're going up. They didn't. They just stayed down the bottom. The futures market did not predict what was going to happen in the future. Then rates started going up, and during that time period, that's pretty much in this whole time frame, the only time the futures market kind of got it right. But then, of course, along came COVID, rates collapsed again. But I just love what happened at the bottom there. Look at that flat line at the bottom where 2020 out to 22, where COVID is, and the futures market is saying, yep, rates are going to stay low for a long time. They're not going up again. That's those little, bottom ones coming off the bottom flat line there. But, of course, inflation came along. Rates started going up around the world. RBA, the Federal Reserve, the BOJ, the EU Central Bank, they all raised rates, and the futures market lagged once again. It was predicting, okay, they'll go up a bit, but then they'll level off. Okay, up a bit, but then they'll level off. All I'm saying is the future is incredibly difficult to predict. You can't predict the future. Even the futures market can't predict the future. That's why you have a diversified portfolio. That's why you buy and hold and stay with your investments over the long term in a diversified portfolio. Having said all of that, these are our predictions of the future. So Vanguard has the capital markets model where we go through all of the various asset classes using our various economic models to try and predict what is going to happen in the markets. I can predict that every single number of these numbers will not actually occur, that the real outcome will be different to all of these. Having said that, these are our best projections. And what you should be looking at is that 50th percentile distribution in the middle. That's our middle prediction, given all of the range of outcomes that our models predict. So we're saying that over the next 10 years, you should see about a 5.8% per annum return from Australian equities. International equities unhedged, you should see about 5.3. US equities unhedged, about 4.5. Remember, we're saying US is just going to probably underperform international and Australian, over the next 10 years because they've got stretch valuations at the moment and so on. But that's how we're looking at the future. We think that markets are going to keep trucking along pretty well. But of course, we don't know what's going to happen. No one knows what's going to happen. Again, just to reinforce it, thus you have a diversified portfolio. But these are our best projections of the future outcomes for various asset classes around the world over the next 10 years. And the picture is pretty good. It's not as good as the last 10 years because we've had a really good 10 years in the market with a few blips like the COVID blip and all the rest of it. It's been a pretty good 10 years. We expect growth in markets, particularly equity markets, to slow a little over the next 10 years. But there should still be some pretty solid returns over that time as well. And that's my last slide. That brings me to the end of my presentation, Lance. So I'm not sure if you've got any other questions that you'd like to ask or any of your clients there have come through with that they might want to ask. But I'll just, put it back to the first slide. And, thank you.
Fantastic. Thank you so much, Tamas. Everyone, don't forget, please, if you have any questions, do drop them into the chat there. We don't have any right now, so I'm going to go ahead and ask a couple of my own. I did have one pop up as you were speaking there, Tamas, about the Mag 7 and how much the index is, how much everything seems to be weighted toward the Mag 7. They're really driving the vehicle at the moment. My question relates to the release of DeepSeek earlier in the year. I don't know if you remember that.
That's the Chinese one?
That was the Chinese one, yeah. So if there is so much volume is sitting with the Mag 7 right now, and then another country, say China, most likely China, I'd probably say, are able to produce a cheaper, faster version of those companies that are holding up the market. Does that mean there's a little bit of a threat there? Is it possible for a lot of that volume to just be kind of cut off in that situation?
Yeah, I think the way I'll answer that question is when you have that much concentration in an index, it does make the overall index a little bit more risky because you are essentially so much of the performance comes from such a narrow range of stocks. If it was across all industries, all sectors, they're all growing wonderfully. So not just industrials, but also health and materials and all the rest of it. That'd be great, because if something happens to one sector, well, you've got the other sort of 9 sectors to basically carry you along. You're right. What's happening is that we've seen the disproportionate amount of growth come from just the tech sector, and particularly just the Mag 7 stocks. And more recently, particularly because they're all in on AI and everyone's making AI bets about the future. So yes, that is a risk, that someone could come along with a better AI model and essentially wipe these things out. And look, I think back to, I used to use Alta Vista as my main search engine, and then Yahoo before that, and all the rest of it. And then Google came along and, absolutely wiped out every other search engine that was out there. These things can happen. I mean, they do happen. Look at Nokia. Nokia ruled the world in mobile phones in the late 1990s, and then all the way, and then BlackBerry came along and they ruled the world for the early noughts. And then Apple came along and they went to Nokia, and BlackBerry just went away. So I think that the history lesson is that this can happen. It does happen quite frequently. So yeah, you've got to be careful about, picking those winners. What I would say again is that, we'll talk about the US market specifically. If you buy the index and some little company comes up with a product that absolutely sweeps the market and sweeps everything aside, well, they'll probably be in the index as well, or at least at some point they'll go into the index. And so if you own the index, you'll own that stock as well, and it will, impact the performance of the index. And that's why I talk about buying the haystack. So, it is a risk. But and the disproportionate weight of those stocks in the index makes the index riskier. But it also, by owning the index, means you'll likely own the next superstar stock that comes along as well.
Yeah, and that does lead in perfectly to Alex's question, which is there's a lot of chatter in the wings about the AI bubble. Some big names are talking to it and are acting on it. Does this change anything, or is it still just a matter of buying the haystack and holding?
Look, I think it's buying the haystack and holding, because you've got to have a very specific view on AI, which, I think GPT and Grok and, Gemini and these things, they're wonderful. They're awesome tools. I love using them. They're incredible. But I don't know where it's going to go. I don't know who's going to come up with the next model or the next, disruptive technology. I don't know how it's going to be implemented. I just don't know. So the way that I would invest is simply by just buying the index, and you therefore will get that company as it comes up and the next blockbuster company that comes along. So I think that AI, I think perhaps what I can predict with reasonable certainty is that not all of the current AI companies will be successful. So a couple of them are going to succeed, and they might succeed incredibly well, a bit like Google or Apple or something like that. But a lot of them is just going to drop away. And as I said, we've seen this before. I remember in .com, back in the late 90s, every .com was coming to market, and, like pets.com and stuff like that. And they all just went away. But Google succeeded, and some of the other sort of .coms, they disproportionately succeeded, which made up for a lot of the failing .com stocks that were in there. So there's a little bit of .com about what's going on at the moment, I think, with AI.
Okay, perfect. And thank you so much, Tamas. And thanks for the question, Alex. That does bring us right to the end of the session. I do have, just before we say goodbye, I have dropped the link to a very quick survey into the chat. If I could please ask you guys to click through and complete that one for me. Because it does help with my KPIs, and you will get me on give me a good glean from my boss, but also because it will help us improve your experience. We want to know always how we can keep improving Fox and Hare and keep improving the service that we are providing for you. So please do fill that one out. Let us know what you think. Let us know what you thought of today. And I will definitely be using that to improve the experience in future. As for that, thank you very much, Tamas. That was an amazing presentation. I feel like I'm walking away more enlightened. I said at the beginning that I'm a marketing guy in the finance world, but I do feel a little more learned now. Thank you so much.
You're welcome, Liam. And thank you to your clients as well. Appreciate your time. Thanks.
Perfect. Thanks, everyone. Have a great day. And you will be receiving the recording of this webinar and a brief blog post as well. Thanks, guys. Bye.
Bye.